Welcome back and happy holidays, y'all. We're doing another installment of Market Snapshot. This time is a little different though. We've got a special guest, Jay Papasan, to talk about all things related to the Fed's announcement recently, as well as a few other key points for real estate today. So hi, Jay.
Hey, it's happy to be here.
I'm so excited to have this conversation with you today. And as always, we want to start out with what are the key things that we should be talking about to our folks watching today?
So I think the three topics we can cover, because the November numbers aren't out yet, right? It's from NAR, so we don't get to talk about all of the stats. We can talk about the big Fed announcement, which was the last one for the year, which really impacts the whole economy.
Absolutely.
I think we can talk about the state of the economy, which is kind of directly impacted by the Fed statement, and then how that rolls down into the mortgage market, which will impact all the numbers that drive real estate.
Absolutely. So start us out. What was that announcement? What did they say?
Well, I think everybody was thrilled to hear that they're not doing anything.
Yeah.
Right? So we're not raising it. And if anything, the expectation is that they may be lowering it next year. And so since the very beginning, everybody complained that the Fed was slow to react. Like, wait, you let this inflation get way out of hand. It caught you by surprise. And then we started talking about this soft landing, like it was a unicorn to be caught in the forest somewhere.
Right.
And I mean, it really looks a little bit like they've managed it such that the economy as a whole might be in for a soft landing. And it's kind of like the average temperature in America. Okay, it's 70 degrees. That doesn't tell me what to wear in Austin, much less San Francisco.
Right.
So even though the economy as a whole did not go into recession, we know that there are parts of the real estate market that are absolutely in a recession.
Absolutely.
So we just have to acknowledge that not all parts are treated equally, but it could have been really bad.
For sure. And I think it was a breath of relief that people are either taking right now watching this or took as they heard the Fed make this announcement. Because what we've been really grasping at and not really understanding in the real estate industry is, why do we continually see mortgage rates going up? Our economy seems to be doing well. Like, Fed, tell us, help us. Why mortgage rates, right? Why is this happening to us? And so anything else that you gathered from what the Fed said and what we think next year might look like?
The things I was paying attention to, a lot of people are forecasting that they might actually have reductions. And I think that's very much,
It's great news.
They're Cheshire Cat up there. Like,
Sure.
They really do not want to be completely understood so that they can deny anything. They're trying not to be super predictive, but everybody's expecting them to drop it next year. If we go into the year and the economy continues to stay cool but not hot, if inflation keeps lowering, I think we're at 3.1% right now, year over year, which is way down from last year. Honestly, the 2% target is kind of arbitrary. Came from a jingle when they were trying to fight inflation in the 70s in New Zealand.
Okay.
But it worked. And so everybody's like, well, 2% seems to be good, but the difference is not that much. I think if they see it start to spike up again, all bets are off.
Sure.
But it looks good right now. And that just makes everybody happy. Businesses love a predictable environment.
Yep.
Even if it's predictably bad or predictably not great, they just want something they can predict. And it looks like the next couple of quarters looks like things are heading in the right direction.
We love to hear that, of course. And
Right.
to your point, I saw that the Dow hit its highest high ever after the announcement. And we hope in the real estate industry that that's going to give us an indication of what's to come in mortgage rates, as you said, that if the Fed chooses to lower rates, then we might also see some reprieve in those mortgage rates, even though when you and I were talking, that they're not always tied 100% together, right?
No, I think Ruben, if he was here, would tell us it's a lot more to do with the 10-year treasuries. And but they're generally considered connected in some way.
Sure.
And so maybe it's an emotional, like the stock market.
Right.
Like, there's no reason for the stock market to rally like it did, other than it's kind of a positive sentiment, and that's what they're looking for to finish the year.
Yeah.
So I think the next stop is, what does that mean for the economy? Mm-hmm. So I think they're saying that this year's GDP growth is going to end up at about 2.5%. Anything above 2% is good. Like,
Yes,
4%
great.
or higher is kind of almost too hot, but it's certainly not dropping into negative territory, which was the fear.
Great,
You
yeah.
keep hiking up rates, raise the cost of money, nobody wants to invest, people start to pull back, everything costs more.
Right.
So it could have cratered the economy, but it's really resilient. I think unemployment's still at 3.7, which is low.
Very low.
So you've got this weird contradictory environment where they've been fighting inflation, which usually kind of puts out the fire. And what they've done is they've just lowered the temperature, and it seems to be working for now.
That is such great news. So what I'm hearing you say, and what I've also learned from Ruben in our conversations, is it sounds like the Fed is feeling good. Why they're not choosing to raise rates again. That's their only hammer for the nail of inflation.
Yeah.
And things look positive. On that same note, the economy in general, as you said, it's kind of an average across the board. It looks positive. Mm-hmm. So we should be seeing some positive movement for real estate. If we think about those two things moving in the right direction, the hope is that that also means the real estate industry, mortgages and sales of homes should also be moving in a more positive direction than maybe what we've been experiencing the last 3 months.
I certainly hope so. When people have jobs, right, and they have confidence in the economy, and consumer sentiment actually finally went up a little bit.
That's great.
And they were saying it's because gas has stayed down. It's so tied not just to general inflation, but to the cost of food and gas, right? Those things that every single week you have to dive in and you're shocked or you're happy, one or the other. So consumer sentiment's getting better, and that generally tends to lead people towards a more positive outlook on the real estate market. So on to mortgages.
Yeah.
Like we were laughing, within 24 hours of them saying we're not going to continue to raise rates, and in fact they may come down, what happened to mortgage applications?
Craziest thing, I saw an article that said mortgage rates, or mortgage applications rather, went up 19% just on the news that the Fed wasn't going to raise them anymore. It's incredible.
I know, and it's that optimism. You gave me another statistic the other day. You said that if mortgage rates, correct me if I'm wrong, hit 5.5%, like 60% of buyers said, I'm jumping back in.
Yes.
So we're going from 7 to the high 6s right now. Right. I think what we know from both of us working with Ruben, it's not necessarily the magic number that has to hit. The direction matters a lot. When it starts to drop, buyers get interested.
Yeah, that trend in the right direction is what really should, we hope, kick people off the fence and say, now might be the right time to buy, because there's always the right time to buy the right piece of real estate. Gary Keller has taught us that. And it requires more than just the mortgage rate. It requires a real conversation. The good news being, it looks like we'll see mortgage rates trending down based on what the Fed has decided. It looks like buyer sentiment is going up as mortgage rates come down. And so it looks like it's a possibility that we'll see more sales in Q1 than we saw recently, and more optimism in the market, which will continue. You said something to me also about the slowness that the Fed wants to take because they don't want to swing too far in one direction or the other. That really impacts our market too, and how fast people come off the fence.
If it heats up too fast, they will start raising rates again. And there's like this kind of magic balance that we found so far, like the soft landing. Can we do a soft landing in real estate? And that is, if buyers keep coming back, can we get sellers who were kind of locked in at that low mortgage rate, and y'all have talked about that in the past, to think, well, it's not so bad now. I can sell my house. So we need a few factors. We know that buyers are going to show up. We have a limited inventory still. Will we have more sellers jump back in the market? And if we can slowly kind of keep those two, more demand, a little bit more supply,
right,
home prices won't go through the roof. We do expect them to go up, but that will be mitigated if we can just get more home supply on the market.
Absolutely. And part of that sentiment, that slow roll back into lower mortgage rates and keeping that demand tempered, is part of the conversation we should be having as realtors, as buyers and sellers, deciding whether or not to come in the market. Because when I hear from a lot of folks, I'm just gonna wait. And I'm like, I get that. And the question back should be, tell me more about what you're waiting for. What does that mean to you to wait, right? Because if it's price, I don't know about you, Jay, but I keep seeing things going up, right? Since July of this year, they just keep going up. So are we thinking prices are going to come down?
No, I don't think that we'll get enough supply. I think they might hold steady or go up slowly. I really doubt they're going to go down. I mean, there's always some pocket of the market. There'll be foreclosures, but not a lot of them. There'll be some parts that'll be hit harder. I expect prices to go up next year as a whole.
Yeah.
So I think that's a mistake. I think what you can do, here's a good rule of thumb, if you're working with your realtor, for every 1% in mortgage rate, that translates in a 30-year mortgage to about 10% of the cost. So if your mortgage rate goes down 1%, it's like a 10% drop in the cost of the monthly mortgage rate. And that's a good ratio. So like, what am I looking for? Well, if mortgage rates came down 0.5%, that would be this percent reduction in my actual monthly payment. And that's actually what I'm looking for. Can I get back into my monthly affordable payments? Now I'm back in the market.
Yeah. So what I'm hearing you say, and we talk about this a lot, is you should really sit down with a professional. If you're thinking about doing anything with your real estate, buying, selling, investing, sit down, talk about the market, talk about what the financial impact is to you as the home buyer or home seller, and how we can utilize the market of right now to either make that decision to go, or based on all the information, make a decision to still hold for a minute. But I think holding for holding's sake or holding for prices to come down is probably not going to happen.
No, it's not thoughtful. That's why you work with a professional. They can help you diagnose exactly what you need to be looking for so you can make a great real estate decision. And it's local, right? It's not about what city or state you're in. It's probably about what neighborhoods and what price range you're looking in. So I would definitely work with a local professional and say, like, this is what we want. This is what we're waiting for. Help me know what to look for so when we know we're getting back in the market at the right time.
Yeah, absolutely. And like always, we'll be monitoring what's happening next, and we'll be back again next month with another market snapshot. So don't forget to subscribe now so you don't miss a moment of what we talk about next time.